this is what we call a bear wedge pattern, or essentially a bear flag consolidation. Inevitably, if you looked at this chart 100 times, 70 plus times out of that 100, this would break lower. And so again, probabilities are not telling us something good here. It's telling us that the economy is likely going to weaken.
Gareth Soloway is back. He is a chief market strategist at InTheMoneyStocks.com and president of Verified Investing Education. Welcome back, Gareth. Always good to see you.
Hey, so good to see you as well, David. Thanks for having me.
Thanks for joining us on this wonderful Thursday afternoon in the middle of September, right before the Fed meeting next week. They're probably looking at a lot of data that came out this week. So let's recap what happened. Just yesterday, inflation data came out, 3.7% headline inflation. So slight tick up from the previous month. It doesn't look like, and that's the second month in a row that inflation's been ticking up. What's your read on inflation? Is it coming back?
Yeah, so from what I'm seeing here is we're seeing inflation stay sticky. So I don't necessarily think we're going back to 9% or even 5%, but I do think inflation, and this is something I've said for a long time, it's going to remain sticky around 3 to 4%. And the problem with that is that eventually when the economy does weaken, the Fed is going to have a very hard time cutting rates substantially or printing money because inflation is going to remain elevated. So it's going to be a tricky road. Right now, markets generally are pretty happy. We're not that far off the recent highs, but I do caution people to be careful going into the end of the year and 2024.
Okay, Gareth, one of the reasons for why inflation has been rising, according to people I've talked to, is the higher oil price. So if you could please pull up an oil chart and show us some analysis there, maybe walk us through your rationale for why it's rising and whether or not this trend is likely going to continue.
Yeah, so that's absolutely part of it. And today we saw that PPI data, which clearly showed that the PPI core, which includes food and energy, was the part that upticked, right? That was the part that came in with more inflation. So that really just points to that food and energy source as being the culprit. And we can see right here, I mean, oil trading now above $90 a barrel and has run up since June, right? June lows were $67 a barrel. So you're not that far away from a 50% move in oil prices at this point. And of course, that's inflationary. It's a tax on drivers in the U.S., obviously at the gas pump with gasoline. And ultimately, what I'm seeing on the charts is we do have a little extended move here based on oil's uptick, but I do think that there's continued upticking or upside until about $96 to $97 a barrel. Once we get there, I still am in the camp. The economy, the U.S. economy will be starting to kind of stall out, and that will likely cap oil prices. But short term, it looks like the momentum will carry through. A couple things I want to quickly show you. We just talked about the Fed's kind of analysis on the CPI and PPI data. The one interesting factor here is that CPI and PPI, even though it came in hotter than expected, we didn't see yields run higher. Now, what does that tell us, right? Here's the 10-year yield, right? You can see that clearly the last couple of days, we've actually come in a little bit from those highs. And that tells us that the Fed, the market is saying the Fed is still not likely or more likely to raise interest rates in the coming months. So we might get one more rate hike in November or December, but essentially the market is telling us that is it. Otherwise, if this inflationary data was telling us rates were going to go higher, we'd see the 10-year spiking much, much higher as well.
Yeah, it's a good point because the CME Fed Watch tool hasn't changed the outlook for the September rate hike or Fed meeting. The probability is... Yeah.
And I was just going to add, and I think it's really important to understand what that's telling us. Smart money is telling us that the economic data is going to start to get worse later this year into next year. And that's why you're not seeing the bond market pricing in higher yields across the board. So again, you have to look at the nuances here and see what it tells us. And so as an investor in stocks, I'm starting to kind of look and say, okay, the VIX is trading at the 13 level, which is historically very low. It's the fear gauge. And so I'm actually starting to say, okay, now is a time to press on these shorts a little bit into year end, into 2024.
I think that is the consensus, what you just said, that next year's economy will deteriorate. This isn't just your view now. It's Wall Street's view. Bank of America, Citigroup, their chief economists have all come out saying that they're pushing back the recession outlook until next year. My question is, Gareth, if it's happening next year, would you not want to stay long for the next 3 months?
That's a good question. And the key is this is right. Generally, the markets price in 6 months ahead. So whatever you think the market or the economy is going to do in 6 months, the stock market will start to price that in. And interestingly enough, if we look at the S&P 500, let's bring up an S&P chart here. We can kind of see that already happening, right? If you go back, the all-time highs occurred in July of this year, or at least not the all-time highs, but the highs in this period occurred in July. If you fast forward 6 months from there, that puts us December to January of 2024. And so, again, if you look at what's going on, are we making now lower highs? We haven't made lower lows yet, but we're starting to put in this potential topping signal, which could be distribution. When you get wedge patterns like this, and you can see it's forming a triangle, that's telling you there's distribution. We still know the retail investor still thinks there's no landing or a soft landing. So if you're not making new highs, it's telling you someone is selling or players are selling into that. Investors need to be aware of that.
This is another key data point that came out this week, going back to economic data, is the NFIB Small Business Optimism Index. It decreased slightly by 0.6 of a point in August to 91.3, so it's a continuous slight decline. Here are the key findings. I'll just read this to you. Small business owners expect better business conditions over the next 6 months, deteriorated 7 points from July to a net negative 37%. 40% of owners reported job openings that were hard to fill, down 2 points from July. The net percent of owners who expect real sales to be higher decreased 2 points from July to a net negative 14%. So things are still not terrible, but starting to deteriorate, starting to roll over slightly. Are you observing that in your, analysis in your everyday life?
Yeah, absolutely. So the consumer still wants to spend, but it's getting harder for them to spend, right? We know we have $1 trillion in credit card debt out there. The U.S. government has that trillion basically of interest payments. I think if we look at the next year or so, there's $7 trillion in U.S. debt that has to be essentially refinanced. We know the mortgage market is dead right now. Worst mortgage, data since 1996, I believe it is. So there's a lot of pressure building here. It's just, again, that savings and the liquidity from COVID, it takes a little while to suck it out of the system. And I think that's what we have going on right now. And so ultimately, I think by the end of the year, early 2023, the markets again will turn decidedly lower. And investors, again, you just prep for that. I love gold. I mean, we'll talk about that, I'm sure, but there are ways to protect yourself. There are ways to be defensive. You just have to be proactive.
So the Russell 2000 has been lagging all year while the S&P and the NASDAQ have been grinding higher. We know why. You've talked about this several times on my show because the 7 or 8 tech stocks have been driving up the main index. When you look at that, Gareth, do you think it's time to either short the S&P? Well, we know that you're short, we're initiating short positions, but do you also then at the same time go long the Russell if you think that maybe there's some divergence that's going to catch up here, or do you just stay out of that as well?
So in general, I wouldn't go long the Russell. And the Russell to me is the pure index, meaning it's 2,000 stocks. It excludes those magnificent 7. So it's a much more realistic picture of the entire economy. 2,000 companies excluding the magnificent 7. And then you're exactly right. If we look at the QQQ, right? The Qs here, and there's a bunch of trend lines on my chart, but look at the rally that had in the Qs. And again, basically because of the magnificent 7, it's gone up this much. But even that started to stall out. If we look at the chart of Apple, for instance, Apple again is getting close to breaking this low, which would then put in a lower low. We already have a lower high in place. So the magnificent 7 are starting to roll. That's not going to be good for the overall markets. And then we know that the rest of the charts, and if we go back to that IWM, this is what we call a bear wedge pattern, or essentially a bear flag consolidation. Inevitably, if you looked at this chart 100 times, 70 plus times out of that 100, this would break lower. And so again, probabilities are not telling us something good here. It's telling us that the economy is likely going to weaken.
Since you brought up Apple, I'd like to ask your opinion on this. I know you've spoken about the risks of Tesla potentially getting banned in China. Let's extend the similar analysis to Apple. Recently, Apple has announced, the Chinese government has announced that they're extending their sanctions on Apple to government employees. So now they're banning certain government employees from using iPhones. I think that now this ban is extending to smartwatches as well. The fear that some people have brought to me is that this sanction could extend to all of Apple for all of China. The markets certainly don't believe this narrative now. You're pulling up an Apple chart. It's not collapsed, because if Apple were banned in China, they're one of the largest markets for them, the stock would collapse. So let me just get your take on all this.
Yeah, so I mean, overall, to me, it's you're right. You have to be aware of that, and you're now to me, it's a downtrend on Apple. We just haven't made the lower low yet, but we know even before the China news that Apple's revenues, especially for iPhones, were starting to drop. And granted, they introduced this new iPhone 15, but look at how many options you have: the iPhone Max Pro, the iPhone this and that. To me, that's a company that's saying, "Holy cow, how do we figure out how to just sell people a little bit more on a different version and bring in more money because our core products are not selling like they used to." And so again, then you throw in the mix that China, like you said, the government saying, hey, you can't use these in government buildings and government offices. Then throw in the fact that we haven't even priced into Apple a slowdown in the US. And this is the way it is with most of these companies. You haven't priced in a recession. We're still pricing in a soft or no landing scenario. So to me, you have to be very careful here over the next 6 months and 12 months, even with Apple, even with some of these mega companies. And that even goes, by the way, for NVIDIA. NVIDIA, we know that right now there's literally no competition, but every semiconductor company out there is saying, holy cow, look at those margins. They are coming for NVIDIA, and it's going to hurt margins there too.
Yeah. Well, people are already coming for Apple. In China, Huawei is taking up their shares, right, but Huawei is banned in the U.S., so we can't use them here. Right. How do you feel about Chinese tech stocks right now, just on a technical basis, or Chinese markets overall?
Oh, I'm glad you asked that. So interestingly enough, the chart of Alibaba is not bad. Now, you have to, as a technician, right, as an investor, you have to gauge risk. And so the chart here, it's one of my favorite charts out there, right? We have a trend line. It's literally hovering right on the low end of this. If we zoom out, this stock traded in 2020 north of $300. We know that valuation, if this was a U.S. company, it'd be one of the cheapest, fastest growing companies in the U.S. But because it's in China, it's been discounted, and rightly so. There's always a chance of an invasion of Taiwan. And so what I would say is this, is that you take a small speculative portion of the portfolio, and I'm speaking for myself here, and you inch into a little bit. You don't go to the point where if something bad happens like it did in Russia, right? With Russia, they basically didn't allow you to trade any of those stocks anymore in Russia. You don't want to risk that with the Chinese stocks. But again, for a small spec position, this could be an easy 2x, 3x type of play if nothing goes on, if things get better in terms of relations with China. So again, the charts are actually good. The K-Web's another one. This is the ETF that tracks most of it. You almost even have an inverse head and shoulder pattern here, right? We have shoulder here, head and shoulder. And then the only thing that hasn't happened at this point is you just don't have a breakout. But it would be something I would watch. You just have to be fully aware, be fully transparent on the risks involved in investing in China.
It's interesting how the Chinese markets have not at all followed the U.S. markets. If you look around the world, actually, the FTSE 100, the London Stock Exchange, right? There's nothing to do with the S&P 500. When you look at that as a technician, what do you think? What's your first impression?
Yeah, I mean, I think that there's this disconnect, right? I mean, you have markets that perform well. What we've seen is the U.S. markets up until 2021 were so addicted, and everyone wanted to be in them because the Fed was printing money endlessly. And so there were leftover markets that didn't participate. For instance, Brazil, China, various other areas of the world. And now you're starting to see, in my opinion, a not as lucrative investment opportunity in the U.S. And I do believe that something like Brazil is on the verge of breaking out. In fact, I want to show this chart of the EWZ here because it's a powerful one. In fact, even going back 6 months, I think I brought this to your attention. And essentially, you have the 2008 high on the EWZ, and this is the ETF that tracks Brazil. And look at this trend line, and look at what's happening right here. We're starting to kind of try to break out on this chart of EWZ, and you break out. I mean, think about just going back to the 2008 highs. And by the way, think about where the U.S. market was in 2008 and where we are now. We are way above it, but you're actually way below it with the Brazilian market. And so you could actually turn in a 3x just going back to the 2008 highs in Brazil. And remember, they're much more of a commodity-based economy, which in my opinion is where you actually want to be with inflation globally higher.
Gareth, let's talk about Bitcoin now. Let's pivot to Bitcoin. Now, Bitcoin has, let's talk about the price action. So this year, again, to recap, up quite a bit, still down from the highs, still tracking the NASDAQ somewhat. what's your read on the price action right now, and what's next? It looks to me, from my perspective, it looks to me like it's waiting for the ETF news. We saw a rebound a couple of days ago or weeks ago when the Grayscale SEC case was resolved and Grayscale won, and then it came back down when the SEC announced that they were holding off on ETF applications until October. It just seems to me like Bitcoin's waiting for news. What do you think?
No, I think you're highly correct on that. Is that most investors in Bitcoin are hanging their hat on the approval of a spot ETF. We've heard even of filings for a spot Ethereum ETF by ARK, and I think there was one other player. But there's no doubt that investors are. My bigger concern, and by the way, right now, if you're a bull on Bitcoin, you're hanging in there, and I'm going to tell you why. Because we came down, and it was nasty that we did come down here, but we never took out the low from June, mid-June. And so what you have is you have a low, a higher low, higher low, higher low. And right here, we never took out that low. So technically, you still have a higher low. As long as that holds, you could make a case that, okay, this was a pullback waiting for the spot ETF news. Maybe it can retest that 31 to 32,000 level. If, on the other hand, we break this level, which is around 24,700 and change, and you make a lower low, technically that breaks the uptrend of higher lows, and you have to get very, very nervous. Now, I think that the spot ETF news is going to be a net positive for Bitcoin. My biggest fear for Bitcoin is that the NASDAQ, if the economy slows down, like I think it is, the NASDAQ has potential for 20 to 30, maybe 40% downside. And how does Bitcoin hold up in spite of that, right? So if you told me the NASDAQ was going to drop 30%, where is Bitcoin? I would dare say it's a lot lower than it is now because people will be running for cover in all risk assets. And like you mentioned, it's still generally a risk asset. So for me, at least, I'm very cautious here. Doesn't mean I'm not slightly long here and there for swing trades, but I want to see what happens if the NASDAQ starts to fall. We know the Magnificent Seven have started. And I just want to show you this chart. This is a big deal here to me. And I apologize for going into this stuff. But if we go to our weekly chart of the NASDAQ, look at what's happened here. So I basically drew arrows showing the .com era and what the formation was, and look at what we have here. So this was a lot smaller because you didn't have as much quantitative easing in the mix and the COVID money, but you had this big move up, then a pullback, then an epic bounce, and then the big .com collapse. Well, if you look over here in the recent history of this market, it's the exact same formation. And that is very alarming to me because of what happened with the .com collapse and how it kind of played out. So again, these are pattern formations. It doesn't mean it's going to absolutely repeat, but when you look at this stuff, you have to say, this could be something that could play out. There's a probability in there, and it has to be taken seriously by investors.
I've seen these double tops in a lot of things. Usually when you see a double top like that, does that usually mean a correction?
It usually does. I mean, again, you have two types of tops. This one was a lower top with a rollover after a big bounce. It convinces all the people to go bullish again. Or then you have the other scenario, which is the M top, which is the double top with a slightly higher high, which was the Bitcoin 2021 top. And then we know what happened there. So either way, it's not a good scenario, whether we go to double top and hit that high, which means we go back and make a new all-time high, or if we roll over here, they're both a negative scenario for the overall stock market.
That's an excellent point. Can you just maybe pull up the Bitcoin chart to illustrate exactly what you just said? Because that was what you just said was very important.
Yep.
A lot of people in 2021 didn't see this, and I was actually a friend of mine who brought it up to me. I think you brought it up to me as well, but you see exactly that. Went up, down, and then in the second top, exactly what happened in 2017.
Yep, exactly. That's exactly what it is. And just so everyone's aware, the psychology behind this is really important because you had the high at 65,000 and we actually broke above that high in the second top. The reason that happens is because the markets have this tendency to want to flush out stops. So think about if you're short, you're probably putting your stop right at that high because if it breaks out, everyone was saying it was going to go to 100,000. It broke out, stopped all of the bears out. And then anyone who was on the sidelines and like pseudo bullish, once they broke that top, it gets everyone to jump long. And so it kind of gets everyone max offsides on the trade, which then enables that bigger rollover to happen. It's amazing if you get into the mindset of trading and investing.
So evaluate this strategy. So given that a lot of risk assets have shown this pattern, wouldn't you wait for something to move up to near its past high and then get in because you know that's when FOMO starts to kick in. Just write it out for maybe 5-10% and then sell, knowing that perhaps it's not going to go much higher. Is that
So
is
you
that
can.
yeah.
That's definitely an option. To me, that's a very high risk option because your downside, if it doesn't happen, is so massive, like we saw in Bitcoin, like we saw in the .com era. But again, it's just a matter of your risk tolerance. For me, I'm always someone who likes to buy low. I don't want to chase and buy near the highs, just hoping for that next little blip. To me, that's like a meme coin or meme stock play where you're hoping to sell it to someone else real quick. I'm never that fast, so I like to get things at the lows.
Can we talk about, well, first of all, before we get into another asset class, I mean, let's talk about your strategy for just a minute. I think one of the things people like about you, Gareth, is that you mix the fundamentals with the technicals. So you take a chart and then you explain perhaps why things have happened the way that it does. But more generally, Gareth, do you believe that a chart fully reflects the news all the time?
No, it doesn't, right? Fear and panic are the number one factors in the market, right? So emotion controls all of us, you, me, everyone else. When people get fearful, they're going to dump in panic. When people get greedy, they're going to buy and just FOMO in, essentially. And so you do have this disconnect between fundamentals. And we saw that in the .com era. We saw that in the crypto markets in 2021 and even the stock market. The key is this, and this is what's important about Bitcoin, is that what you're seeing, the grayscale news, the Ripple news, all these filings for spot ETFs. Those are all really good fundamental stories that Bitcoin that are good for Bitcoin. The key is this: fundamentals play out over the long period. It's like building a base. It's like planting a seed. That tree will grow. It's going to take time. Technicals are much more short term based on emotion. And so short term technicals rule, long term, it eventually reverts back to that fundamentals.
Mm-hmm. This is maybe for somebody who is a rookie, they might think like this. I certainly thought like this when I first started reading the markets. Is look, the markets are composed of investors and traders, very smart people. And if something's going up or down, whatever direction that particular asset is taking, it's probably because the winning side is right at the moment. And so why fight the smart people who are right in the moment? Why not just ride whatever trend is in place right now? Is there anything wrong with that logic, Gareth?
So it depends on where it is in the cycle, right? I mean, there's nothing wrong with going with the trend. The tricky thing is, at what point are you getting in? Are you getting in at Bitcoin at 67,000 before it tops out, and then you're looking for 100K, and then you're sitting holding the bag down to 30,000 or 15.5? And I think that's the tricky thing. Is like, for me, I'm much more of a support. I want to buy at support and sell into resistance, and I try to gauge human emotion, and I go opposite this, right? So when you see that euphoria, it's a warning sign. I have these red flashing lights in my head that go off. And same thing when there's blood in the streets, as many famous investors have said, when everyone else is freaking out, you have to be the logical person and say, well, what are the fundamentals here? Does this make sense? And that's usually when you want to buy.
Okay. Well, you mentioned gold. Gold has had a pretty rough second half of the year. Can we take a look at the gold chart, please? And
Sure,
I know
absolutely.
part of the reason is because the dollar has kind of strengthened on the back of a higher yield. But certainly gold has held up pretty well despite lower inflation, despite a higher dollar, despite a higher interest rate. So let's get your read on the latest technicals.
So I would counter what you said and not say it's had a rough second half. Now, is it net negative for the half? Yes, but only by a couple percentage points. And I think this is remarkable, right? So I'm a huge gold bull, and I think the price action has been phenomenal, because if you told me that the US dollar, the Dixie, was going to have this type of rally up just since July, and that gold would basically be flat to slightly negative, I would have said you're crazy. Gold's going to be down in the 1800s, maybe the 1700s with this type of rally. The fact that gold has held up so much, to be honest, it tells me there's big institutional accumulation, and we know that central banks are also loading a boat. And remember, folks, these are the people that are printing all the money, and they know they're going to have to print in the future. So if they're buying gold, it's probably a good indicator that we need to. And just to show my point about the strength in gold, the dollar today is up very nicely, making a multi-month high. And if we go to gold's chart, gold is basically flat on the day, right? So again, to me, that's outperformance on gold. It shows you buyers are coming in even with the dollar strength.
Well, the question is whether or not gold can maintain this strength relative to the dollar. Well, let's before we get into that, actually, let's get your take on the dollar, because, like you just said, gold is very much related to the dollar. Inversely, that is.
Yeah, so the chart on the dollar to me is whether it goes a little higher or not, that's up in the air. But I think we're coming to the end of the run. I think as soon as the economic data starts to weaken, the dollar will start to fall very, very quickly. And almost like the Russell, right? It's not quite like the Russell, but you can make a case that you have essentially this sideways pattern from this high, which again is bearish. And we're right at the higher end of that area. So again, there could be a little bit more upside in the dollar, but I actually have it priced out that in the next year, you're probably going to start to break lower and even eventually get below this 100 level where we made the low back in July. So again, that adds to my bias for gold even more, and maybe eventually Bitcoin when Bitcoin isn't such a risk asset that it really can outperform. But yeah, absolutely. I mean, I think the dollar comes in here from these levels.
Think gold can breach new highs by, let's say, next year when there's a recession, like you projected?
Yeah. Yeah. In fact, I would expect it sooner. So I have the phases of gold right now. Right now, with the economy, you have good news is bad news, which is because the dollar pushes the dollar up. When you have good news, it's bad news for the markets. It's bad news for gold because the dollar strengthens. The next phase will be bad news is good news. That'll be good because it'll drop the dollar. But at the same time, the stock market may hold up because, again, you're getting weakening economic data, which takes the Fed out of play. The last phase is where you get this monumental move, which is bad news for the economy, right? And that's where people start to say inflation is still 3 to 4%. The Fed, again, is out of play. The dollar starts to collapse and gold will just go nuts because even the stock market won't do well. So there's not going to be a lot of options in that final phase. And I think, again, by year end, if not early 2024, we're probably above the all-time highs. And then I think you start getting into this move that we saw in the 1970s. And again, if you look at the inflation gauge and like the process, the path of inflation, it's so eerily similar to what we saw in the 70s that you can't deny it. And we had this beautiful move up here, this pullback, which is kind of what I believe we've seen over the last couple of years, this consolidation, and then the big blast off. And I think that's what's coming in gold. So I think, again, at some point, we're at $3,000, $4,000 an ounce on gold. Could be a couple of years away, but I do think it's coming.
Yeah. Historically, gold has, when there's a huge fall in the markets, gold has usually fallen with stocks, but then is usually quick to recover afterward as well. So given that, if someone were to say to you, Gareth, I don't know if gold is necessarily a good hedge against equity volatility, if you're expecting a big correction in the recession, how would you respond to that?
Yeah, so I think, again, the key is how fast and what causes the markets to fall. So if we just quickly jump back to the gold chart, this was where COVID hit, right? We had COVID coming out and we did have a fall in gold. But look at how quickly gold recovered and went to the all-time highs. So again, that shows you that panic is going to cause people to irrationally sell everything. That includes Bitcoin, that includes gold. So if we have a panic scenario, sure, gold will dump in the short term. But then logic comes to play and smart money is buying it, understanding that this is the safety hedge. This is the inflation hedge. Again, when stocks aren't performing, money has to go find somewhere. And excuse me, it likely will find gold.
Okay. Well, let's wrap up here. Correct me if I'm wrong, but I believe Bitcoin is probably the best performing asset this year of the assets we've talked about. Surprisingly, because it's still technically in a bear market. Yeah. Very confusing. Do you think it'll end the year still being the number one player? It's got 3 months left.
My guess is it probably will, but I do expect it lower from here. So again, if we go back, let me just see where we were at the beginning of the year. Yeah, we were at around 16,500. So I think by end of year, we could be back to 20,000, but I don't think we take out those Bitcoin lows until 2024. So I would say chances are, based on that, still like a 33% gain, it probably will be the best performing asset for the year. And I was wrong on that. I thought it would suffer still and gold would be the best performer. I will be wrong on that. I do think at this point.
Okay. So gold won't be the best performer this year. So what are you expecting by the end of the year for gold? We're at 1909 right now as we speak.
I think gold at least retests the 2080 level, so the all-time highs. It's a triple top right now. But again, whether or not it breaks out by year end, that's going to be tricky. We'll have to look at those inflation numbers and the economic numbers as well.
SPY, what's your take on that? And we haven't talked about this slight pullback since July yet. It's had a bit of a rebound, but it hasn't really tested the July high. So is this trend going to continue, you think?
Yeah, so right now I think we're making this kind of wedge pattern. I expect it to be a bearish breakdown at some point. I think that coincides with some of the economic news coming out. And I do think, again, we head lower by year end from where we currently are.
All right. Good. Do you have a support that would make sense for you to, like, let's say gets to that level, it's really going lower from there?
Suffice it to say that short-term support on the spiders will be around 420. On the SPX, on the S&P 500, that equates to around the 4150 level. But again, I'm in the camp where I think we break far, far lower in 2024 due to the economic situation that's going to unfold.
I remember a while ago, we talked about Bitcoin when Bitcoin was at its highs, and you were calling for Bitcoin to go to 20,000. You were going to go buy with both hands and feet. Is there a price level at which you're going to buy with both hands and feet now?
Yeah, I would say I buy one hand at a time and then with one foot at a time. So it's essentially dollar cost averaging in, right? So again, I've learned my lessons buying all in at one entry price. So the thought process to me is add some at 20, add some at 17, add some at 15, and just keep kind of accumulating since I'm a huge, huge long-term bull on Bitcoin.
Okay, fair enough. If it goes the other way, would you still dollar cost up, I guess? Does that make sense?
Yeah, so if it breaks out above 32,000, I let the breakout occur. It generally charts retrace to the scene of the crime. So if it came back there and we had a breakout, I would be buying that level too. Yep.
Where do we learn more from your trades and verified investing? Well, I guess I just said it. Verified investing. Go visit verified investing. Where can people learn from? What can people learn from that course?
So at Verified Investing, I have the Winning Trader series. It's 20 hours, 3-course series. Everything I know about charting, everything I know about psychology is in that thing. It is amazing. It'll blow your mind. And then I have a service there called Verified Investing Crypto. We have other educational offerings coming to the table in the next couple months. And then In the Money Stocks is where I do my commodities as well as my stock calls and trade setups. So you can find me there. Find me on Twitter, YouTube. I do the game plan every morning at 9 o'clock, 9 a.m. Eastern time. It is free and it is mind-blowing stuff. We go over charts for 30 minutes.
8:30. How do you discipline yourself to get out of bed?
Well,
you talked about discipline a lot in your
I've
trading
got kids.
course.
I'm up earlier than that with kids.
Have you ever considered doing an update to your course? Let's say in a couple years down the line, let's say you accumulate new knowledge or new experiences where you want to update some methodologies. Would you redo it?
Absolutely. There's things, and that's important. The core values seem to hold true because they're based on human psychology. But overall, there are little things that change, and you always have to be, as a trader, flexible with that stuff. Otherwise, you get yourself in trouble.
I like to see the day you integrate AI with your trades. Hit me up. We'll talk about that.
Yeah, that'll be interesting. I look forward to the day I can retire and let my AI do all my work for me.
Yeah, the Gareth Soloway AI trading bot. That'll do well. All right, thanks very much for your time today, and we will talk again soon. Appreciate it.
I look forward to it. Take care.
And thank you for watching. Don't forget to like, follow Gareth, and subscribe.